shares of Netflix are skyrocketing, up over $114. That's a good 13% in the after hours. That's after the company announced their Q4 earnings. And this thing is gone straight parabolic. We'll have to draw some new lines on here technically because we've got a new uptrend and it is steep over at Netflix. We'll talk about the Q4, talk about some of the things that went on in the quarter. We not only got kind of upcoming Q1 guidance from the company, came in a little bit light, but the company also gave us full year 2025 guidance that is reassuring most investors. Talked about a couple of things in their shareholder letter, which were interesting. The low penetration they believe they have in many markets. They also talk about their ad plan as well, how that accounted for the bulk of the signups that they are seeing. And they don't even have a first-party ad opportunity for you, meaning that you as an advertiser, you have to go through a rep or those types of things. Well, that's coming soon to the United States. Well, speaking of the United States, I mean, you had massive signups, the NFL, the Jake Paul, Squid Games, all those types of things, just showing you that this company is firing on all cylinders. We'll look at it financially as well. The content investments that they are making do come at a cost. And so we'll have to talk about that. But we'll also have to talk about investors don't care. They are pumping this one up big time. And we'll look at Netflix technically. What is going on, investors? Hopefully, guys are doing well out there. If you own Netflix, you are having a great day. You're going to probably be one of these millions of people, which they say spend approximately 2 hours per day. The average member spends 2 hours a day on Netflix. I don't know where you guys get the time, but if you own Netflix shares, you probably popping a cold one and you chilling because you're up 78% over the past year. And even year to date, you are down. But now you are riding absolutely much, much higher. We'll talk about the Q4 here in a moment. I do want to focus on the guidance as well. This is what typically moves stocks. The Q4 was fantastic in a lot of different ways, but Q1 is a little bit of a mixed bag. The company is guiding to $10.4 billion worth of revenue. Wall Street estimates were actually a little higher than that, about 10.48. The high end was $10.69 billion. About $10 billion was kind of the midpoint estimate. So they're coming actually up a little bit short on the revenue or right in line, but they are guiding to higher operating margins than I think people anticipated. 28.2% operating margins. That's going to give you net income of $2.4 billion in the upcoming quarter. For reference, the quarter that we'll talk about today, Q4, they printed just $1.9 billion. You also had a re-acceleration of memberships. This is globally up over 301 million now. That grew nearly 16%. It's a re-acceleration over the previous period. Talk about here when we get to kind of the segment results as well, how you had those big sign-up numbers in the two key regions where they're able to charge the most, both the United States, Canada, and Europe. Now, the company also gave us kind of a full year 2025 year revenue target. They're expecting $43.5 to $44.5 billion worth of revenue. For context, Wall Street was expecting a number close to $43.6 billion. The high-end estimate was for $45.8. So the fact that they're guiding towards this, it actually is a little bit increased since the last time they talked about it. That is absolutely great. They're also guiding to higher profitability as operating margin is expected to come in at 29%. It's a 1 point increase. So 29% operating margins over the company will help you show that Q1 is actually going to be a little bit light from the operating margin perspective. 28.2. They're expected to drive these higher as the year goes on. Also, the revenue likely coming in higher as the year goes on. Netflix having an incredibly bullish outlook. They also have a pretty bullish outlook on the fact that, again, approximately 2 hours per day is what the average member spends on Netflix. I mean, I don't think I've spent 2 hours on Netflix in the last 2 months. I don't know where you guys get this time. I wish I had it. but they estimate that there's approximately 750 million broadband households, so households that have access to broadband. And look, things like Starlink, the Project Kuiper that Amazon is working on, they're rolling out fiber with AT&T. Verizon has some initiatives here as well. These things are all good. Obviously, more 5G access as well on if you're watching this stuff on a cell phone connection. This is all good for Netflix. They estimate, and this excludes China and Russia, but they estimate that they've only captured about 6% of this total market and less than 10% of the TV viewing in every country that they operate. So they think they've got a long runway over at this company. Now, the other thing that I think they've got a long runway over at Netflix is actually on their ad business. If you recall, Netflix used to be traditionally just you would pay for it and that was it. There was no ads. Well, now they have an ad tier where it's kind of a low monthly fee. You sit through the ads and a lot of people are willing to do that. In Q4, those ad tier signups accounted for over 55% of the signups. So you got a lot of people that might not have a lot of money, but they might have a lot of time and they'd rather sit through an ad rather than pay a little bit more per month in order to avoid those ads. Their ad plans grew 30%, not year over year, quarter over quarter. My goodness. And that is absolutely fantastic. And now from kind of a really nuanced perspective, they are rolling out what's called a first-party ad tech platform in Canada. This is going to allow you as the advertiser to kind of manage your ads, very similar to how you do on a Google or a Meta. Because Netflix is doing this all in-house, it actually took them some time. And so this first-party ad tech platform is actually critical to the company's growth because they're seeing the vast majority of users, or a little over 50%, are coming in on that ad tier. Now they're going to give the tools to the advertisers, the Pepsis and those big brands. They might use something, but you might trickle this down. This might start trickling down to like small business, where if you operate a gym in Los Angeles or San Diego or Miami, you might be able to target Netflix viewers in your geographic region because they're going to have all that on Netflix. So this is going to turn into a little bit of like a Google Meta type ad platform. And they're going to roll out this first party ad tech. This is exactly what you need in order to acquire more and more advertisers, particularly kind of the middle of the funnel, lower of the funnel advertisers. The Pepsis, the Budweisers, they're just spraying bazookas when it comes to ads, but the more targeted ads are where a lot of the money comes in. In fact, I think that's how Meta and these companies make the bulk of their money. So you won't actually get this in the United States until April. And so this is incredibly bullish, at least from an ad perspective. Now, the company saw a huge, we're talking a massive amount of paid addition. You have that Logan Paul fight. You also had the NFL in the quarter. At least those were kind of the big events on Netflix from a live streaming, and they saw that it worked. Also in the shareholder letter, they basically more or less said they were going to double down on live events because I think what they saw was a record amount. 4.82 million people signed up. The past couple of quarters, your peak was like 2.8 million. So they saw a huge increase there. Expect Netflix to get into probably all of the major sports at some point. They'll continue to do boxing, UFC, anything that they can get their hands on. I think they've also more recently added the WWE, so that's probably contributing here as well. Their average revenue per membership up to $17.26. That is growth year over year and even quarter over quarter. Similar type of thing in Europe. You had 5 million signups. It's the biggest on record since about a year ago. And your average revenue per user up over $11, where it was south of 11 in the previous 4 quarters. The other regions, similar type of thing. Look at Latin America. Over 4 million people signed up. Tick down in the average revenue per member, but obviously these ad tiers will start to funnel into this. And finally, Asia Pacific, nearly 5 million. It was a big quarter geographically across the board. So I don't think you can necessarily pin it down to the NFL or one actual event. It was just this company has a lot of momentum. Now, it is costing the company a lot of money. $10.2 billion worth of revenue, like we talked about. That is growth year over year, even quarter over quarter. But what you will know is the cost of revenues continues to tick higher to $5.7 billion. They also spent quite a bit on sales and marketing in the quarter, nearly $1 billion. That was a lot more than the previous quarter. Technology and development continues to be kind of a steady $750 million type spend every single quarter. And you have general administrative, which stayed roughly flat year over over year. Your operating income went from 1.5 last year up to about $2.3 billion. Previous quarter, though, it was at $3 billion, about $1.9 billion to the net income side. From the balance sheet perspective, it's about what you'd expect with this company. We'll look at cash flows here in a moment, but they're printing a fair amount of cash. They're also buying back the stock over at Netflix. They've got about $8 billion, actually a little more than that, close to $10 billion in cash. They do have some debt sitting here on the balance sheet, but it's more, they have plenty of cash flow, even in a quarter where the cash flows actually were not that great. Last year, from an operating cash flow perspective, this is the cash that Netflix generates operating their business. So when we're talking about net income, it factors in some cost over at Netflix that weren't necessarily cash going out the building. Now, with Netflix, it's a little bit different. Most other companies, we see things like depreciation, which is more of an accounting charge. We see stock-based compensation. Company has a little bit of this here, but it's not a lot. What they have a big number is their addition to content assets and their amortization of those assets. So they buy, let's say they buy like Seinfeld, like the whole library of Seinfeld. So they pay up front for that, a fair amount. And then they obviously monetize that over, maybe it's a 2-year contract. So they're going to monetize that over the membership base over 2 years. So there's some stuff here, cash flows. You don't necessarily have to understand all that. Just understand there's cash going out for content and it comes in every month through membership fees. So there's kind of an amortization there. In terms of net cash provided by operating activities, $1.5 billion. Talked about how last year it was higher and the last quarter it was $2.3 billion. But what Netflix is telling you, at least from some of their guidance, is that it's going to get better as we move into subsequent quarter. The good news for Netflix is they barely have to spend the cash on anything. Purchase of property, plant, and equipment, just $160 million. I mean, this is a really asset-light type of business. So what are they doing with this cash? Okay, so you have $1.5 billion. You only spent about $160 million of it on property, plant, and equipment. That was the only investment you had to make. Okay, so they are buying back the stock to the tune of about $1 billion in the quarter. You're buying back the stock at, these nosebleed levels, but I tell you what, the company continues to print results, so I guess that is fine. They still had some cash left over, the tune of about $348 million. So this company is adding cash to their balance sheet. They're adding a war chest. I actually just published a newsletter today where I actually talked a little bit about some of the entertainment companies. You're going to have a spike in M&A activity after a couple of years of slower action. Some of it had to do with higher interest rates. Some of it had to do with a regulatory perspective, not only here with President Biden, but in Europe and other places. So you should have a softening of that combined with lower interest rates. You should get some M&A activities. There's a couple of companies in the entertainment space that are already kind of being active. Disney was, for one, made an investment in a company called Fubo TV, but you also have Roku sitting out there. I think like a $8 to $10 billion valuation, and there's been a lot of rumors that they might get gobbled up at some point. So could have some M&A activity, could impact Netflix. They certainly could be active there as well. Now, we have a lot of lines on the graph. But we need to clean this up, guys, because it's really a lot simpler than all of this. We are now in that channel right there with Netflix. We are moving to the top of the channel. Tend to divide these things in half. You can clean them up, make them look however you want. But Netflix, from a technical perspective, is looking absolutely sensational. You continue to hold this one. If you do want to take profits, you've just made or confirmed a new higher high on these ones. When you confirm these new higher highs, you want to reallocate, reorganize your portfolio. No one's going to blame you. Also, no one's going to blame you for continuing to hold. Those of you that want to get into Netflix, you're waiting for pullbacks back into this channel, because this channel is now looking absolutely, this is as textbook. This is what you dream of when you're looking at stocks and when you're in this channel. Some people wonder when you buy the dip. You look for these channels. When you get dips, you step in there and buy. You can combine it with a little bit of fundamental stuff. If the CEO's out the door, they just committed fraud, those types of things, you might not want to buy at the bottom of the channel. But if everything's looking good for Netflix, and certainly I think the most bullish thing that the company talked about that most investors are not going to understand is they literally haven't even rolled out an ad platform that is available to the vast majority of advertisers out there. And they're not going to roll it out into the United States until April. And so this is about as bullish as it can get from just not only a sign-up perspective, but a momentum perspective from their ads. Netflix firing on all cylinders, and I think it gives us clues of what we are to expect over the next couple of weeks from the other major tech stocks. If Netflix is doing this well, you better believe what's going to happen over the next couple of weeks. Buckle up. Lots of money to be made in 2025, and hopefully you guys will make some of it. That about wraps it up for today. We'll be back, as always, for the Fang Stock Recap Show on Friday. Till then, good luck with your investments.